So, Josh, you wrote a post the other day called Double Your Money.
I did.
Where you're basically talking about the most powerful force in the financial universe.
Yeah.
And that is compound interest. Where did you come up with the inspiration?
Well, I was thinking about money doubling because I came across a stat that even without dividends, the S&P over the last 9 years, which pretty much is the entirety of the post-crisis period. So it's 108 months, you doubled your money. And you did that despite the fact that a couple of years during that period were negative, last year being a really good example. But then I was thinking, like, that's maybe a little bit oversimplified. Like, just put your money in and every 8 or 9 years you'll double it. So I start out with the rule of 72, but then I get into sequence of return risk, which I don't know. Do we want to explain what that is? Is that like...
Yeah, I don't know if that's good for video, but
All right.
You said something that I thought was great. You said the mere presence of a potential risk is not a reason to not invest. Risk is why investing pays off in the first place. That is like the perfect answer to Nasho Japan.
Yeah, and you know, I come across like this question all the time, especially as I do financial media all the time. And
that's funny. I do financial media.
You do financial media, but a lot of like the premise of a lot of TV segments or a lot of articles that we read is like, this is the risk that investors aren't ready for, or this is the risk that no one's talking about yet.
Oh, what about the risk that's hiding in plain sight?
Yeah. Well, but it's just like, all right, of course there's risk. That's why you're going to get 7 or 8% in stocks long term, and you're going to get 2 or 3% or 3 or 4% in treasuries. And I get that's not inflation adjusted, but it's just like, that's what you're being paid for. So I start the piece off talking about the rule of 72. And for people that aren't familiar, it's just a very quick and dirty way to figure out how many years it'll take you to double your money at a given rate of return.
So I think the reason why people have trouble grasping this concept of compound interest is because our brains think linearly.
Yeah.
So I wrote about this a few years ago that ask anybody, hey, what's 6 plus 6 plus 6 plus 6? And they're like 24.
Right.
What's 6 times 6 times 6 times 6? I'm like,
I don't even know. What is it?
I don't know. Who cares?
Right.
So
it's harder to do.
Yeah. So this concept is from a book called The Art of Thinking Clearly. So he said, a piece of paper is folded in two, then in half again, and again, and again. How thick will it be after 50 folds? So you take a piece of paper and you fold it in half 50 times.
So you're doubling the width of it with each fold.
Yeah. So if you take like an astronomical guess, so a piece of paper is 0.004 inches thick.
Right.
So after 50 folds, take a guess. How high?
In inches?
Whatever. Take a guess.
I don't know, 50 feet high, 100 feet high?
Over 60 million miles.
Stop it.
This is the distance between the Earth and the Sun.
How many times do you fold a piece of paper?
50.
So...
Take out a spreadsheet, 0.004 inches. You fold that 50 times and you're to the sun, 60 million miles.
So who could possibly think that way?
So it's impossible. Our brains were not built to think that way.
Right. This is so in my post I'm talking about like things don't double in your life. Like you don't start with 2 kids and then the next day it's 4 kids and then you have 8 kids. And the example that I was quoting an author, Byron Reese, he's talking about the invention of chess. And the guy who creates it, this is like 1,000 years ago in India, goes to the ruler and he says, I want you to take a piece of rice, put it on the first square, then double it, 2 pieces on the second square, then 4 pieces, etc. And all I want at the end of that, in exchange for this gift of chess, I want all the rice that would be on the 64th square after all those doubles. And so you say, like, how much would that be? Would it be a ton of rice, 10 tons of rice? Some ridiculous number like 500 tons of rice, and it actually turns out it would be more rice than has ever been cultivated in the history of the world.
It was worth as much as all the gold that's ever been mined.
Right. So it's like some insane number. And there's other examples like I used you take a domino, and if you just made each domino in consecutive order 50% bigger than the last, so not even a double. After the 32nd domino, you'd be able to topple the Empire State Building. So, yeah, compound interest, compound growth, it's impossible to visualize more than 5 or 6 steps out for most people.
So that's like an extreme example of showing something doubling and doubling and doubling. Obviously, investing doesn't work that way.
Portfolio won't do that many times in your life.
But 6% on 6% on 6% on 6%, like It's astronomical. But Morgan tweeted about this the other day. Is that like the problem is it's such a long game, and the payoff doesn't happen until like 40 years from now.
And there are setbacks
right
while that happens.
Right.
Which we're not going to do a whole thing on sequence of return risk, but you could compound for 30 years, and then the market gets cut in half in your 31st year, and then it might be a while before your next double comes along. But so you can double your money. But as you do that, the risk of dollar loss ratchets up because you have more dollars,
and the risk of like staying the course or whatever it becomes.
So I mean, not to make this into a commercial, but like that's what a financial plan does for you. It says here is the potential for a sequence of return disaster by using something like a Monte Carlo simulation, and say like, here are thousands of paths that the investment markets could take from here, and under certain scenarios you could have something catastrophic happen, but not under most scenarios. And I think planning for that is really what a financial advisor is supposed to be doing, not saying, ooh, here's the risk you didn't think about, let's not invest at all. So I think there's too much of the latter, not enough of the former when you consume financial content. I mean, would you agree that that's generally the case?
Yes.
All right. That's all from us. Let us know what you think about the concept of compounding, sequence of return risk, anything that you want to talk about. Tell us in the comments below. Make sure you subscribe to the channel. We are about to break 5,000 subs. We love all our subs. We love your feedback, and we'll talk to you soon.